Welcome to the Deep Dive, your shortcut to being well-informed. Today, on our Talk Tickers segment, we're really digging into JBT Marel's Q2 2025 earnings call. And let me just say up front, this was a quarter that definitely turned some heads, some compelling numbers here.
Oh, absolutely. It's quite striking how decisively they showcased their strength after that big merger. You saw the market reaction, right? Shares moved up nicely.
Yeah, speaks volumes. Seems like investor confidence is, well, renewed.
For sure. In their strategic direction, definitely.
Okay, so let's jump right into the snapshot then, because these results, they really do demand attention. Starting with the financials. Non-GAAP EPS, the adjusted figure, an impressive $1.49.
Yeah, and that wasn't just a small beat. It sailed past the FactSet consensus, which was around $1.28.
So what, $2.21 spitter? That's pretty significant.
It really is. A strong signal of, operational outperformance right there.
And was that strength just in EPS, or did it flow through elsewhere?
No, it wasn't isolated at all.
Right.
Look at revenue. $934.8 million. That easily surpassed the consensus range, which was, $897 to $950 million.
Right, so anywhere from $20 to $37 million above expectations.
Exactly. And maybe more importantly, that's a huge 132% year-over-year increase. Of course, the Marel acquisition is the big driver there.
Okay, makes sense. And adjusted EBITDA, how did that look?
Also very strong. $156.2 million, which gives you a really robust margin of 16.7%.
16.7%. Didn't that beat their own guidance?
It did, by about 180 basis points or 1.8 percentage points above their guidance midpoint.
Wow. Any reason given for that outperformance?
Yeah, they pointed to a favorable product mix.
Yeah.
And just, excellent productivity, things clicking operationally.
And cash flow. Always crucial after a big deal.
Absolutely crucial. And they delivered there too. Yeah. Free cash flow is a powerful $88 million just in Q2.
$88 million. That's got to help with paying down debt.
Hugely. It's really accelerating their deleveraging efforts, which is exactly what you want to see.
Okay, what about the future pipeline? Orders, backlog?
Good numbers there too. Booked $938 million in new orders. That actually included about a $22 million boost from favorable foreign exchange.
A nice little tailwind.
Yeah, and that helped build up their backlog to a significant $1.4 billion.
$1.4 billion backlog. That gives them pretty good visibility for future revenue, right?
Substantial support, yeah. And another key piece, recurring revenue, accounted for 52% of sales in Q2.
Over half. That's a healthy percentage. Acts as a stabilizer.
Exactly, a crucial stabilizer in what can be, a pretty dynamic market sometimes.
And the balance sheet impact of all this, you mentioned deleveraging.
Right, they've made huge strides. Bank total net leverage is down to approximately 2.9 times.
2.9x, down from what, around 4.0x when the deal closed?
Precisely, so net debt less than 3 times adjusted earnings now.
Yeah.
Big improvement.
And liquidity.
Still very strong, about $1.3 billion in liquidity.
Okay, so the financial health looks solid. Execution seems strong.
Definitely. The numbers paint a very positive picture.
All right, the snapshot is impressive, no doubt.
Mm-hmm.
But let's maybe get into the weeds a bit. How deep does this strength go? What were the underlying drivers here? Let's unpack this.
Well, management, as you'd expect, was very positive on the call. CEO Brian Deck, he highlighted that results exceeded guidance. No surprise there. He pointed mainly to that robust recurring revenue we just talked about, and also the favorable FX tailwind.
And the CFO. Matt Meister.
Yeah, he really emphasized the rapid deleveraging and the strong cash generation, called them out as key achievements, underscores the financial discipline they're applying.
Okay, makes sense. But for any merger, the big question is always synergies and integration. How's that progressing? That's
where the rubber meets the road, absolutely. And they're showing tangible results already. Realized $8 million in year-over-year synergy savings just in Q2.
$8 million already. How did that break down?
It was $5 million from operating expenses and another $3 million from the supply chain side.
So not just projections, these are actual savings hitting the bottom line now.
Exactly. Real in-the-bank results.
And what about the future? What's the roadmap look like for synergies?
Well, what's really interesting isn't just these initial savings, but how ambitious their plan is. They're saying they're on track for an $80 to $90 million annualized run rate by the end of this year, 2025.
$80 to $90 million run rate by year end. That's fast.
It is. And the target gets bigger. Approximately $150 million annually by year 3 post-close.
$150 million annual target. Wow. How are they splitting that? Cost of goods, operating expenses?
They said it's balanced between COGS and operating expenses. So a pretty comprehensive approach. But crucially, It's not just about cost cutting. The integration is refining their value proposition.
Oh, so?
By combining strengths, they can offer these holistic, full-line solutions. That simplifies things massively for customers' installation, commissioning, service. It makes JBT Marel more of a single-source partner.
Ah, so it increases customer stickiness, potentially future revenue, not just cost savings?
Exactly. Becoming indispensable. That's the goal.
Did they give any specific examples of how this works in practice?
They did, actually. A good one in poultry processing. Combining JBT's DSI water jet portioner technology with Marel's Sensor X inspection, grading, and material handling.
Okay, so mixing and matching the best of both companies' tech.
Right, to create these high-value modular systems.
Yeah.
Especially useful in secondary processing, automating stuff that used to need a lot of labor.
That really illustrates the integration benefit beyond just cost, creating actual integrated value.
Perfectly put.
But value only matters if customers are buying. How's the actual demand environment looking across their main end markets?
Broadly supportive, I'd say, but with some, interesting variations. Poultry, which is their biggest end market, is seeing continued strong equipment investment.
Why is that?
It's largely driven by automation demand. Everyone wants more efficiency, better yields, and poultry companies are generally profitable right now, so they have the cash to invest.
Investing in what? New plants? Upgrades?
Kind of all of the above. Greenfield facilities adding value-added downstream product lines, but also brownfield realignments, upgrading existing operations.
And isn't there a regulatory angle here too, with line speeds?
Ah, yes, good point. New U.S. regulations are allowing faster line speeds up to 250 birds per minute now, with some workarounds.
250 birds per minute. That must create huge opportunities for the kind of integrated, automated solutions JBT Marel can offer now.
Absolutely profound opportunities. And you see it in the numbers. Their combined sales pipeline just in North American poultry grew about 15% in the last 6 months.
15% growth in the pipeline, directly from these synergistic opportunities.
That's what they indicated, yeah. And it actually contributed, they estimate, $5 to $10 million to orders in Q2 alone.
Wow. That's some serious cross-selling proof right there.
It really is. Early days, but very promising.
Okay, what about meat beyond poultry?
Meat is a bit more mixed. The pork segment is showing gradual improvement. Investments are picking up in the U.S. and Europe. Customers are seeing better price-cost dynamics, which helps.
And automation opportunities there, too.
Oh, definitely. Yeah. Especially in the really labor-intensive areas like cut-up and deboning rooms. Huge potential. Beef, however, remains weak. The issue there is mainly the small cattle herd size.
Yeah.
Limits the incentive for big investments right now.
Got it. And other segments, beverages, pet food, etc.
They saw good demand for beverages, fruit and vegetables, and also ready meals. Pharma and pet food were noted as a bit softer this period. Seafood and material handling were kind of neutral.
And geographically, any standouts?
EMEA, so Europe, Middle East, Africa was actually their strongest region in Q2. North America was relatively softer, they said, but still maintains a solid pipeline. Latin America showed strength. Asia Pacific continues to be, let's say, choppy.
Okay, so a varied picture, but generally positive, especially in poultry automation. But this brings up tariffs. That's been a headwind for a lot of global companies. How are they navigating that?
Yeah, that's a critical point. They did incur costs, about $9 million in gross tariff costs in Q2.
$9 million gross. Did they manage to offset any of that?
Fortunately, yes. They said it was largely offset by existing inventory they had on hand and some initial mitigation actions they'd already put in place.
So they're being proactive, not just reactive.
Seems that way. Planning ahead.
What does it look like for the rest of the year then, second half?
They're anticipating a net tariff cost, so after mitigations of about $20 to $30 million for the second half of 2025.
$20 to $30 million net impact. Okay. Are they just accepting that, or do they have plans?
Oh, they have plans. Strong, comprehensive mitigation strategies. Things like really aggressive supplier negotiations, strategically repositioning where they source parts from, like moving some from Europe to the U.S., for instance.
Okay, smart. Anything else?
Yeah, considering alternative locations for equipment assembly, and also proactive pricing actions, both on parts and on new equipment quotes.
So trying to pass some of it through while also managing the cost internally.
Exactly. And their goal here is pretty ambitious, actually. Speaks to their operational focus. They want to achieve price-cost neutrality for tariffs by Q1 or Q2 of next year.
Neutrality by early next year. That would be impressive if they can pull it off.
Very impressive.
Yeah.
And interestingly, while they saw some episodic order delays, maybe linked to tariffs, they reported, and I quote, Literally zero impact on the protein side of the business.
Zero impact on protein. That's huge, given how important that is for them.
It really is. Shows they can maybe insulate key high-value segments from these macro pressures.
Let's zoom in on Marel specifically for a moment. You mentioned strong overall margins, but how did the Marel segment do on its own? I heard those margins improved quite a bit.
It did. Very impressive, actually. The Marel segment hit an adjusted EBITDA margin of 15.5%.
15.5%. How does that compare year over year?
That's the kicker. It's a 400 basis point improvement, 4 full percentage points better than last year.
400 basis points. That's a massive jump. What drove that?
It's a combination of factors, really. First, those synergy savings from the integration are clearly flowing through. That's number one. Second, some restructuring efforts that Marel has started before the deal closed are now bearing fruit.
So some pre-existing momentum there.
Right. Third, that favorable mix of recurring revenue. We talked about higher margin stuff. And finally, just better underlying margins in their core meat and fish businesses themselves. Things are improving operationally within those units.
So a multifaceted improvement. Are they expecting this to stick?
They seem confident. Management is actually targeting mid-teen margins in both fish and meat by 2027.
Mid-teens by 2027. That's a strong long-term outlook. Shows belief in continued improvement.
Exactly. A clear, ambitious trajectory for the Marel part of the business.
Okay, so putting it all together, let's look at their guidance. What's the outlook for the rest of the year?
Right. They reestablished full year 2025 guidance, which, after a big merger like this, is a strong sign of management confidence in itself.
What are the numbers?
A revenue projected between $3.675 and $3.725 billion. Let's call the midpoint $3.7 billion. Adjusted EBITDA margin expected between 15.25% and 16.0%, and adjusted EPS guided at $5.45 to $6.15.
Okay, solid guidance ranges on the adjusted figures. What about GAAP EPS, the official accounting number?
Yeah, important distinction for you to note. GAAP EPS is actually projected to be negative. The range is minus $1.90 to minus $1.20 per share.
Negative. Why the big difference from adjusted EPS?
It's mainly due to non-cash and one-time items. The biggest one is acquisition-related amortization, which, just for clarity, is basically the accounting way of expensing the value of intangible assets they acquired, like brand names, customer lists over time. It hits reported earnings, but isn't direct cash outflow.
Got it. Accounting rules impacting the bottom line. What else is baked into that guidance? Tariffs, FX.
Yep. Their second half assumptions include that net tariff cost of $20 to $30 million we discussed. And they also expect an FX tailwind to benefit from currency movements of about $70 to $85 million for the full year.
Okay, so netting out tariffs and FX, what does this imply for the quarterly shape, Q3 versus Q4?
Good question. For Q3, they expect revenue to be roughly flat compared to Q2, but they expect margins to dip sequentially by about 100 basis points or 1 percentage point.
A dip in Q3 margins. Why?
Mainly due to those increased net tariff costs hitting harder in Q3, plus a less favorable product mix compared to the very strong Q2 mix. They did say ongoing synergy savings will partially offset that dip, though.
Okay, so it sounds like a temporary headwind they're anticipating and planning for.
Exactly. Planned headwind is the key phrase. Because looking ahead to Q4, they project a strong margin recovery. Q4 is expected to be their highest margin quarter of the year.
Highest in Q4. Any shifts in seasonality we should know about?
Yeah, they mentioned some shifts compared to historical trends, mainly because Marel has a heavier weighting in Europe, which has slightly different seasonal patterns.
Okay, so a clear path overall, managing some near-term bumps with mitigation plans in place.
That sums it up well. Active management.
All right, let's shift to the investor context. How did the market actually react to all this news?
Very positively. I mean, the stock jumped about 5% intraday on the day of the announcement, August 5th. It closed up 4.6% that day, and importantly, on significantly spiked trading volume.
So, real conviction behind the move.
Seems like it. And what's interesting is this bullish reaction came despite management guiding for that Q3 margin pressure.
Right. So, investors were looking past the short-term dip.
Clearly. They seem to prioritize the strong Q2 beats on earnings and revenue, the healthy orders, that big backlog, and maybe most importantly, the clear, executable synergy roadmap. They like the bigger picture.
Any reaction from analysts? Upgrades, downgrades?
Yeah, positive sentiment there too. William Blair, for example, upgraded the stock to outperform. that signals a definite shift in perception.
So the narrative is changing.
I think so. It's clearly moving beyond just, okay, the deal is done, to, wow, look at the operational proof. It's starting to validate the whole thesis of this combined entity being a diversified, automation-focused food tech player.
With rising recurring revenue and that clear cost takeout plan.
Exactly. It's a crucial pivot in how the market views the company. They're seeing the tangible benefits now.
All right, you know what time it is. This is not financial advice segment. Time to pitch an outrageous but plausible trade idea like we're in front of the investment committee. Okay, investment committee, listen up. The Q2 print from JBT Marel wasn't just good, it was a clear inflection point. They didn't just meet expectations, they exceeded them across the board. This validates the whole food tech powerhouse thesis we've been discussing. Management didn't just hit the numbers, they absolutely smashed them. And the market's initial reaction, a decisive buy. So my wild yet plausible idea here, it plays on the acceleration we're seeing. Acceleration of synergies, those demonstrable cross-selling wins, and frankly, the market's tendency to undervalue these solid recurring revenue stories until the proof is just undeniable. So here's the pitch. I'm proposing a long call spread targeting JBT Marel, ticker JBTM, for Q1 2026 expiration. Specifically, let's look at a bullish 155-170 call spread. Now, for those maybe less familiar, a call spread means buying one call option, say the 155 strike, and selling another call option at a higher strike, the 170. It's a way to profit if the stock moves up, but within a defined range. Gives you leverage, but caps your risk. Okay, why this trade? Here's the rationale, straight from our deep dive today. We've already seen 15% growth in the North American poultry pipeline from cross-selling alone in just 6 months. That's just the beginning of what they can do commercially together. And management's commitment, their goal to get price-cost neutrality on tariffs by Q1 or Q2 next year, that strongly suggests this Q3 margin dip everyone's talking about is temporary, a blip, not a trend. The market's positive reaction so far, that's just a glimpse. The full potential isn't priced in yet. Think about those targets. Mid-teen margins in fish and meat by 2027, $150 million in annual run rate synergies by year 3. The current stock price, even after the pop, doesn't fully reflect the compounding effect of these improvements over the next, say, 12 to 18 months. So the 155 strike keeps us close to the action. The 170 strike captures significant upside as this operational proof story really takes hold. I think this could drive the stock well into the mid-160s, maybe higher, by early next year as execution continues. This spread gives us leveraged upside, caps our downside. We're betting on continued acceleration and execution. And Q2, that was a resounding yes to both. That's the pitch.
Okay, that's definitely a bold play, but grounded in the strong results. And just to reiterate the core takeaways from the call itself, JBT Marel delivered a truly robust Q2. No question. Strong financials, yes, but also showing remarkably successful integration progress already.
Yeah, the recurring revenue growth, the healthy market demand, especially for that poultry automation.
Right, and those proactive, detailed strategies they laid out to handle the tariff situation, all very positive signals.
And while, yes, there's that small expected margin dip in Q3 because of the planned tariff costs,
the overall trajectory for the company looks undeniably positive. You saw it in the market reaction, the analyst upgrades.
So the focus for JBT Marel now, it's clearly on execution, right?
Absolutely. Continued execution of that synergy roadmap and converting that massive $1.4 billion backlog into sustainable growth and profit.
This quarter definitely showed they're not just talking the talk, they seem to be walking the walk. So, as you continue to watch JBT Marel, maybe consider how these early integration wins and strategic plays could compound over the next few quarters. Thank you for joining us on this deep dive into JBT Marel's latest earnings. And remember, all discussions here on Talk Tickers are strictly for informational purposes, definitely not financial advice.
Please consult a professional for any investment decisions.
We hope you'll continue exploring the world of earnings calls with us next time.